Okay everybody, today I'm going to have probably one of the most important YouTube videos that I can do, and it is going to talk about how early retirement is more possible than you think with covered calls. I want to walk through what they are, I want to walk through what options are. It's going to be a lot of stuff, and this is going to be a longer than usual video, but we're going to walk through examples because I want everyone to see the power in this strategy. And again, it's not for everybody, but if you are interested in early retirement and you don't think it's possible, I'm going to show you at least one option that may interest you. Before I go any further, if you are getting value out of my content, there are 4 simple things I want you to do. First, like this video. Second, subscribe to my channel. Third, hit the bell so you get alerted when new videos come out. And then lastly, share it with your friends. They all need to hear this message, and I'm here to share some hope. And I think you're going to really like this. And what we're going to do is we're going to walk through some examples here later on. So I'm going to show you what is possible. But first, again, we're going to talk about early retirement with covered calls. And I want to start with the very basics. What is a call option? So most people think of them is when you buy them. So when you buy an option, what you are doing is you're saying, hey, I want to buy 100 shares of stock at a certain price. So you might buy a $150 call on Apple, which is basically saying, hey, I own a contract and it will allow me to buy Apple at $150. Even if Apple goes to $300, I can still buy it at $150. Now, here's the catch. By a certain date, options expire. And that is an important thing to remember, is that options do expire, and they do, and it depends on how far out you buy, but they do expire. And there's a component to that, is, and we're going to talk about this, is you actually do pay a premium for the contract. So contracts are not free. You're going to pay money for this because there's a risk. Like the person that sells the call, we're going to talk about that in a second, they get that premium, but they're forced to sell their shares at $150. So we're going to talk about that in a second. But most people, when they think of it, they think of they're buying it. So that is what you're doing essentially there. Now, what you are doing when you buy it, what you're doing, let's say you buy, I cannot write. Let's try another pen here. Find the proper name. It's not working here. You buy a that expires this Friday. So you buy a $150 call for Apple that expires this Friday, June 3rd. So here's what you're betting on, okay? You're betting on Apple. This is Apple's share price. You're betting, here's what you're betting. You're betting that by the end of the week, that Apple is above the 150. That's what you're betting on. And if you're right, no matter how high above it goes, now you're gonna have to pay for 100 shares. So you're gonna have to have $15,000 of cash to take those shares, right? 150 times 100 is 15,000. But this is what you're betting on. You're betting on, hey, I think it's gonna go above that. Now, that is the kind of the very basic level. Now, obviously, there's a premium, so you want to go high enough up that it covers the cost of that premium also. But essentially, this is what you are doing. When you buy an option, this is what you are doing. You are doing this, okay? Now, here's the thing, is how you're like, okay, so I know basically how what you talked about with buying an option. Well, let's talk about the other side now. Selling options. And we're going to talk specifically about calls. Now, when you sell, you're required to sell you're required to sell the stock to the option buyer. And this is important because you want to make sure that you're okay with that. So in other words, when you sell an option to somebody, like if I sell you an option, I am saying I'm obligated to sell you my shares. So let's look at the Apple example again. The Apple example. And you know, I showed it going up. Here's the 150 strike. Okay, so what this is telling me here, okay, is if it goes above there, since I sold the option, I'm obligated to pay, or I'm obligated to sell it to you for 150. Even if it goes to $200, I still have to sell it to you for 150. Now, I can get out of that by buying the option back, but obviously if the option goes up, the option it will cost me more to buy it back. So you can buy contracts back, whatever you want to do. But again, I'm not talking all about that. I'm talking simply when you go in here and you're selling an option and it goes up here, no. The person that buys it says, hey, no, I have this contract with you that says I get to buy your shares, your 100 shares for $150. You have to sell them to me for that. And your broker will automatically do it. But that is essentially what this is when you sell an option. Now, what happens though? What happens if, in this case, let's do this example. So I'm trying to make this. Let's say you sell a $160 strike on Apple. But Apple, maybe it gets close. It gets close by Friday. Doesn't get there. What does that mean? Well, the option's worthless. Why is the option worthless, you might ask? Well, let's say it gets to 158. Okay? Let's say it gets to 158. Ask yourself this. Why would I want to buy your shares for 160 when I can go in the open market and buy them for 158? That's why the option is worthless. And that's when that happens, the option is set to expire out of the money. So when it expires out of the money, like this, guess what? That premium that you paid, or the premium that the buyer paid, it's gone. They paid it already. The contract is worthless. But the premium that you got for selling it, you get to keep. And that is the thing that you want. You want, when you're selling options, you want to keep your shares. You want to keep keeping your shares. So you want to sell them far enough, called out of the money. So that's called, like when the price that you're obligated to sell, this 160, you want it to be way past where the share price is, so that the share price has to go up quite a bit to even make any sense. And so this is a key point in the strategy is you want to keep your shares as much as you can. Because what ends up happening is if it goes above that, your shares will get called away. Now you can always buy them back, and it's not like you didn't like lose all your money, because they have to pay you for these shares. If it goes above 160, in this case, they're going to have to pay you $16,000 to buy those shares. So it's not like you don't lose all your money. It's not like that. But this is one of the key things with covered calls that you have to understand is like your goal is you want to make it where it expires out of the money. And so this hopefully makes a little bit more sense here. And what I want to talk about is the potential here. And I want to show you what I believe is truly possible with options. I think conservatively, I can't talk. I would say 1/4 to 1/2 per week. I think the premium income that you generate from an option conservatively, and I'm going to show you examples. So I'm not blowing smoke up your butt. I'm going to show you examples. And I really believe that you can earn 1/4 to 1/2% on your shareholdings per week. Now, what does this mean? Let me translate this to you. If I have a $100,000 portfolio, 1/4% per week translates to, I think it's $250 a week. Let's make sure my math is correct. So 1% of 100 would be 1. So it'd be 1,000. Yeah, 250 per week. 1/2% would be 500 a week. So you do this for a full year, extrapolate out to 50 weeks. What does this become? What's 250 times, I'm trying to think, about 20, what is this, like $12,000, $25,000? This adds up, and this is only a $100,000 portfolio. Imagine if you multiplied this by 5, what would this be? $2,500 a week. That's over $100 grand a year. This is the power of selling options, and this is exactly why you should at least learn. And there's actually a great book, Covered Calls for Beginners. Is actually a fantastic book. I would recommend reading it. Now, there are some rules. You might be asking, okay, what do I need to get started? So what do I need? What do I need? Number one, I'm going to use purple because my green one's dying on me. On my ink side on me. So the first thing you need is 100 shares of stock. I say that because one contract is 100 shares. You cannot sell an option, a covered call, if you have less than 100. If you have 99, it doesn't count. But if you have 100, you can sell one contract. If you have 200, you can sell 2 contracts. So you can see how this multiplies out. But you have to have 100 share blocks. Oh my gosh, man, my markers, I swear to God. It has to be optionable. This means you have to be able to run options on it. So this is why you want to focus on these bigger quality names. They're going to have options that expire every week. This is what you want. And you can tell because you can go and look, and there'll be an options chain, which is the list of all the options that are out there on these. You want to avoid ones public that only have monthly expiration because there's just a lot less liquidity at that point. Like you want options that are very like companies that are very liquid. They have a lot of trading going on. It's very easy to sell options. So you want them to be optionable and preferably weekly. And then you have to get approval. So what does that mean? That means you need to go to your broker and you're going to have to request options access. Now, you should be able to get very basic low-level access for, and be able to easily get that way. It will allow you to write covered calls and cash secured puts. That's usually the lowest level of option access. And that's all you need to do this, is to be able to sell them. This is what you need. So again, I want to show you the power. And here's what we're going to do now. I'm going to go over to my computer and I'm going to show you some examples and I'm going to show you how this is possible. I really think this is possible. And if there's more questions that you guys have, leave them in the comments. I may have to do additional videos to kind of walk through them with you. But again, I want to show you the power in this because it is so powerful, and it is such a great tool that if you master this, you could really generate some passive income on a relatively small amount of invested capital. So I'm going to show you. We can go through some examples. Hold on a second.
All right, guys. So as promised, what I'm going to do is we're going to show 4 different examples. I'm going to show you what's possible. And I picked $300,000 as good good capital amount. I think that's fairly attainable by most people. If not, you can always feel free to scale it. But this is an example. And we're going to go through 4 different stocks. As you can see here, I have the S&P 500, which is SPY. I have the QQQ, which is NASDAQ. I have Apple and NVIDIA. So 4 different stocks. And here are their share prices. Here's how many shares you could buy with $300,000. So you can see that here, and how many contracts you can write. So obviously remember, you can't write on partial amounts. So you have over 700 shares, I can write 7 contracts. Almost 1,000 shares. So if you can get to 1,000, you can write another contract. But right now you can only write 9. You can write 20 for Apple with its share price right now a little under 150 bucks. And then for NVIDIA, you can write 15 as well. So you can write 20 for Apple. I had it flipped. So this is going to show you what is possible. And what I'm doing here is I'm going to assume you're only going to write them for 45 weeks of the year. And then you're probably like, why is that? Well, you might have a couple weeks of vacation, you don't want to do it, or maybe there's also like earnings, like Apple and Nvidia will have earnings 4 times a year. And typically on the weeks that have earnings, because the share price could go any which way, I don't write options on those weeks. So there's 4 weeks there plus a couple more. Let's round out to 45 weeks and we'll call it good. So I'm going to show you, but I'm going to have some assumptions here that I want to point out. That's the big one here. So here's the assumptions, and the big one here is important. So when I talk about delta, and that is one of the option Greeks, and you're probably like, what the heck is that? Now you're just throwing this random stuff here. You didn't talk about this before. Delta is a measure of how much, if the stock goes up $1, how much will the option go up? So if you have a delta of 1, that means that if, let's say, Apple goes up $1 a share, the option will also go up $1 a share. So that means the option would go up $100 because option represents 100 shares. That's a delta of 1. If it's a half, it will do it by half. So what we're looking for is a delta of 0.2 or less, because it typically approximates the chances that your option will expire, that you will get assigned at expiration. So if you want a 80% chance that your option will expire out of the money and you will get to keep your shares plus the premium, you want to go far out of the money, which means a delta that is fairly low. I like 0.2 or less because that means I get an 80% chance that I'm going to win on that trade. You can go higher. You can go higher than that if you want to. If you want to go to 0.9, just know that the higher you go, the less premium you're going to get on selling those options. So it is all a kind of a trade-off, if you will. So it's completely up to you and your comfort level. And so I'm just telling you what I think. Another thing you can do too is if it pops. So let's say Monday it opens really, really strong and it pops. Maybe that's when you sell the call because the stock has already moved up quite a bit. And then it's an 80% chance at a higher level. So you can do it that way too. So there's different strategies, but I'm just assuming that you're going to sell options and you're going to sell them like a week out. And we're just going to go from there. And again, I want to show you, this is all about what is possible. I'm trying to teach you what is possible with covered calls, because I think too many people realize that early retirement they think it's out of reach. And I'm showing you an alternative, and I'm showing it to you with some basic funds. So let's go through, and I'm going to show you, now we're looking at TD Ameritrade. And what you're looking at here is an option chain. So this is the option chain, and this is going to be, let's type in SPY, which is the S&P 500. And it's going to load the option chain. And what you can see is there's a bunch of different options, expirations. You can see them all here, all nicely laid out. Thing you want to look at here, these percentages, these are over here. and you could get these on Yahoo. I think you can pull options. You don't have to have Thinkorswim. It's a great tool if you can if you want to sign up for it. You can usually sign up and get like a paper trading account, which is a account where you're not using real money, and you can do it that way. But yeah, these percentages are what is called the implied volatility. The higher the number, the more volatile the stock, and generally the higher the premiums too. The other thing that you see over here, these plus or minus numbers, these are how much do the market makers, people that are like Citadels and all that stuff, how much do they think when they sell these up? How much do they think they're going to go up? Again, the higher the number, the more volatile, and it's all relative to share price. So obviously, if you have a $2,000 stock, these numbers will be a lot higher. But it's all about what do they think? And so when you look at like June 3rd, which is this coming Friday, they think that SPY could go up or down, seven points. That's at 415. It's like 422 or 408. We don't know. So let's say we're going to do week out, and we said we're going to look for a delta of 0.2, and I'm going to show you. Here. So we're going to scroll down. This is June 3rd. Remember, okay? And I'm going to go look here, and I'm going to go to, we're right here, right? So we're at 425 or 426. Remember, we're at 415. So that means SPY would have to go up a good bit for these options to be worth anything, right? So let's look. So we'll do this 19. We'll be conservative. We'll stay below. You can see here, probability out of the money. It means 82% chance of it expiring out of the money, which is great, right? It follows my rules. We want it to be way out of the money. Now you can see a bid and ask. Generally, if you just do a market order and you're just selling right then and there, you're going to get the lower price here, the bid. This is what the lowest price that a buyer is willing to pay, or the highest price a buyer is willing to pay. This is the lowest price a seller is willing to sell. If you want to get fancy with it, you could probably do like 104, 105 and put like a limit order in, but we're not going to talk about that. We're just going to assume the lowest here, $103. So, and the reason I say 103, because you're like, it only says $1.03. That's per share. Remember, option has 100 shares in it. So that means the option, if you sold it, will give you $103 of premium. So now let's go back to our example and say $103 per contract. So $103 per contract. Let's add this here. How much does that give you per week? So we'll add this here just to illustrate the example. So $720 per week on 300 grand, $32,000 a year. And I just messed it up. So what is that percentage? That percentage is, if I take this divided by 300, and it might be a little less than a quarter. It's about 0.25%, exactly what I was telling you. And here's the thing. That is about what I told you, 1/4%, and that's way out of the money. And it's on the S&P 500 fund. This is not some penny stock. This is not some volatile, high growth stock that could go bankrupt. This is the S&P 500. So this is. So I want you to see this. In fact, let's do this. Make this illustration a little bit more impactful here. Make it make sense. Okay. So now I want to show you another one here. Let's do QQQ and do the same example. June 3rd, and we're going to go down. Now, you notice these numbers are a little bit higher. The share price is lower, but they're expecting a bigger move. So a little bit more volatility, which means you'll get a little bit more premium. So let's go back here. Oh, we're right here. Okay, so let's do this. $100, right? Remember, $1 per share. So we're going to go to 100. We're going to go to $100 here. So we're going to set premium per contract there, and then we'll do this. Now you see it's a little bit bigger return, about 0.3% per week. Annualize that over 45 weeks. There you go. Pretty neat, right? Pretty neat. Okay, so now let's up it a little bit. Let's look at Apple. Let's look at Apple. Again, focus on high quality stocks. Okay, so we look at Apple. Now, again, when I look at Apple, I probably would buy this, 82% chance of being out of the money. You get 52 bucks, right? Is that what we're seeing? 52 bucks. Okay, so let's do this, 52 bucks. And sorry, a little bit higher return, right? It's a single stock. That's the thing. It's like, do you want to have that much exposure to Apple? That's something you have to ask yourself. But what you see is the volatility is going up a little bit, but your return is going up as well per week. Okay. So now let's do another one here. Let's do this one that's really volatile. It goes crazy. NVIDIA is a very volatile stock. Okay. And what you can see here is I'm going to show you it has a lot of volatility. Look at this delta. We'll do this delta of 0.19. Okay. And again, I think NVIDIA is a good company, but it moves a lot. Like, it is not uncommon for this stock to be up 3, 4, 5% in a day or down 4 or 5% a day. It can really move. Okay, so we look here. We're looking at a delta of less than 0.2, about an 82% chance of it finishing out of the money. $114 per contract, as you can see here. And this means that NVIDIA has to get to $200 by Friday, or else the option expires worthless. Well, what does that give us? What does that 114 give us? So if I type in 114, $1,700 a week, and that's up over a 0.5% chance. That's over a 0.5% return per week. $77,000 annualized over 45 weeks. So you don't even have to do it every week. 45 weeks a year. This is the power of selling options, and you don't have to have a lot of income. You know what? Maybe you're like, I don't have 300K. Let me do 100K. Let me do 100K because I don't have that kind of money. I don't have that money. Okay, well let's do it. Let's do it. Let's do the math. Okay, and we're gonna do it. And we'll drag these down. So these are now for 100,000. Okay, so now I'm gonna do. Okay, so look, now you have $100,000 in capital, right? And you're selling covered calls on it. Look. Sorry, I want to adjust these down because these should not change. Look at this. Even with $100,000, you can get 14 grand. You can get 14 grand on Apple, 13 on the NASDAQ, almost 9 over 9 on the S&P 500. And the best part is if these stocks keep going up and you keep writing about higher and higher strike prices, you're also getting the benefit of the capital appreciation. Again, this is the beauty of the strategy, is you can do this, and it's so easy to do. And if you want to learn, again, what's the risk? The risk is that stock has a tear and it runs up, which, again, there are strategies, and I'll talk about these in a later video. Like, if you have a stock like that is run and now you're at the risk of losing your shares. But again, I want to show you what is possible. And I want to show you that you don't have to have a ton of money to have some serious passive income from selling options. You really don't. And I want to show you that is possible. And hopefully I've conveyed that in this video. So if you have any questions, drop them below in the comments. I would love to hear them. If you have ideas for other videos related to this, I'd love to bring them up. If you have some of these questions that you may have may require more videos, because it's impossible to talk about everything all in one video. So I hope you enjoyed this. And again, I want to share this with you because I want to give you guys hope that you can do this with these kind of stocks, that it is possible. It really is. So Watch this, let me know what you think, and have a fantastic day.